This is Paul Donovan from UBS's Global Economics Department. The Senate passed the bauble-bedecked bank bailout bill by a large margin. It goes off to the House for their reasoned debate and insightful judgment on Friday. But a funny thing happened on the way to the bank rescue plan. The U.S. economy fell off the edge of a cliff whilst it was waiting for politicians to come to their senses. Yesterday's U.S. economic data showed one of those decisive turning points in economic activity. The ISM index, which was surveying manufacturing sentiment before the events of this past week, was so unremittingly bad, it was one of those numbers that cause economists to avert their eyes in horror. So pessimistic was the detail. Orders down. Export orders down. So the rest of the world seems to be weakening, though there may be some currency effects there too. Employment prospects down, suggesting more weakness in the future for the U.S. consumer. Prices down, inevitably. This is a disinflationary to deflationary environment. We await written apologies, perhaps accompanied by a suitable gift from those who were so assiduous in asserting stagflation fears in the face of economic good sense. For those that get worked up about such things, it seems certain that the National Bureau of Economic Research will declare this to be a recession in the States starting early this year, perhaps as early as the first quarter. And all the evidence is that the period of pronounced economic weakness is set to continue. Bad data plus ongoing money market stress may put pressure on the Fed to ease intermeeting. We cannot rule this out now, though on balance we still have them waiting for the end of the month and the FOMC. However, there may very well be speculation in the market about whether they cut by 50 basis points or just 25. There's an article in today's Wall Street Journal mooting the possibility of further easing in the face of current economic weakness. No such joy from that bastion of policy error, the European Central Bank. We do not see them changing rates today. Some of the rhetoric may have softened, but earlier this week Trichet was still clinging to the idea that Europeans are worried about inflation eroding their savings, rather than the reality, which is that Europeans are worried about their jobs and whether their savings will still exist next week. Meanwhile, the population of France must have woken up yesterday and thought they were in America. The government had a cunning plan to get the rest of Europe to bail out banks with a centralized fund. Unfortunately for the French government, they seem to be finding relatively few supporters elsewhere across the continent, in particular in Germany. Nevertheless, it does seem likely to be discussed as a concept this weekend at the Paris summit. Elsewhere in the world, UK credit conditions, bad, and house prices, bad, are due for release. European producer price inflation struggles out onto the world stage, but is unlikely to excite too much interest. US factory orders data is probably best avoided by those of a nervous disposition. That's all for today. Have a good day.